What's happening, everybody? It's your boy Kreative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all. We're going to be dropping another episode in our KreativeU series. And today we're going to be breaking down how to read a candlestick chart. Now, currently I'm looking at QQQ. QQQ is the top 100 tech companies within the NASDAQ. And this candlestick chart is each one of these candles represents 1 minute of action between the buyers and the sellers. Now today we're going to be going over how to the difference between a big body candle we're seeing right here and these different dojis that are popping out, and what does a wick mean, right, when we're looking at a candle, and also what are the buyers main aim, right, what are the sellers main aim. So we're going to go ahead and jump into our code that we have broken down for y'all today. Before we get into the candlesticks, I think it'll be prudent for us to go over different market terminologies that you may hear when you're watching CSNBC or you're reading your Financial Times or your Economist, right? Or you're being able to go through different financial literature or hearing it, right, to being able to understand, okay, what's really going on, so you can cut through the granular and really get to what's going on. So let's go ahead and jump right into it. So the first thing we're going to go over is the difference between the points versus dollars, right? So when you hear points, it's just another word for dollars in stocks. So when we say that SPY moved up 5 points today, and SPY is the S&P 500, this is the top 500 companies within the New York Stock Exchange, it means that SPY moved up $5. So points equals dollars for stocks and ETFs. Now, one thing I want to be able to delineate here is that stocks, whenever you buy a stock, you're buying one company. That's like buying Apple, Tesla, Microsoft, Google, YouTube, so on and so forth, right? And when you're buying an ETF, you're buying a basket of many stocks. So SPY, like we said before, is 500 companies within that ETF. Both trade the same way, that points equal dollars, right? So when we hear that SPY's moved up $5, we're knowing that, okay, maybe SPY is on an upward or bullish trend, right? And also there are some traders that like to use SPY to be able to gauge what the overall market is doing, right? Because it's the top 500 companies. So if it's the top 500 companies, if those companies or SPY moved up $500, then we can say that, the market is maybe on a little bit of a bullish run, right? But you want to confirm that with many different indexes or many different layers. So let's look at a few other live examples. SPY today, and today being January 27th, 2026, whenever you're watching this, SPY opened at 694 and then now or closed at 695, right? So there was a 1.47 points move, or the SPY moved $1.47 today, right? Now we have QQQ. QQQ is the top 100 companies within the NASDAQ. QQQ opened at 628 and then it closed at 632. The reason it says now is because I'm recording this when the market is closed, right? So I just wanted to denote that the now is when the market is closed. So 632 is when the market is closed. So they closed at 632. So the points were 314, or the dollar movement, it moved $3.14. DIA, which is Dow, opened at 490 and then it closed at 489. So the points were 0.94. So Dow had a bit of a negative day today. Key insights is that higher price stocks, more points for the same percentage moves. Now, something to keep in mind, which we're going to go over next, is that QQQ moved more points than SPY, but which one had the bigger percentage move? Keep that in mind. So another thing to be able to understand is basis points or BIPs, right? The language of precision. So 1 basis point equals 0.01 percentage points, right? So 100 BIPs or 100 BPS is 1%, right? So every 100 bips is 1%. 50 bips or 50 BPS is 50.5. 10 bips or 10 BPS is 0.10. Why? Precision tracking for small moves. Zero DTE traders love it. I mean, I get it, but I don't always go around saying, hey, this underlying stock moved 3,000 bips today, right? Or to being able to understand like the difference here. So let's go back. All right, let's just keep going so we don't confuse you. So converting percentages to bips. So SPY had 0.21%, or that's 21 bips today. So you multiply it by 100. QQQ, 50 bips, right, or 0.50. DIA is 0.19, or at negative 19 bips. So pro tip, traders say up 20 bips instead of up 0.2, right? Because faster, more precision for quick moves. It allows us to be able to deduce, all right, now we can understand by the 10th place, right, how much has the 100th. This is the 10th, this is the 100th, I'm sorry. 10th, 100th place, how much has the move gone, right? So if I say it's up 21 bips, we understand that it's like, all right, 0.21%, bet, let's keep moving. All right, so let's go to the next section. Now, why percentages matter the most? Context is everything when it comes to being able to understand what the market is telling us, right? If we hear that the Dow is down 300 points, that sounds scary, right? But if the Dow is at 43,000, right, 300 divided by 43,000 is 70 bips, or 0.70, barely noticeable. So the percentages lets us compare any asset and any price level. So same percentages at different levels, right? So SPY is at 21 bips, or 0.21%, or it equals the dollar 1.47. QQQ 0.50 bips, or 0.50, or and the dollar amount is $3.14. And then Dow 0.19 bips, or 19 bips, or 0.19%, or and dollar amount 0.94. Reality check is don't be fooled by the big point moves. Always check the percentages to understand the true impact. All right, volume and liquidity. So how many shares are trading? Volume equals the total shares traded today. The average volume is the typical trading, average volume is typical trading, typical daily trading. Why am I getting stopped up there? So average volume is going to equal your typical daily trading. So heavy volume, so a day where there's a lot of activity going on, it's going to be above average, and we have strong conviction. This is where we're going to have our big candle populate, right? Because there's a lot of activity going on. It's above average. When we have above average volume, that's how we know we have such strong conviction when it comes to that underlying candle that we're reviewing. Light volume is going to have below average volume, so not that much activity, not that much conviction. That's how we're going to denote that this is a weak signal. So high volume confirms that the moves are real. So today's volume, when we're looking at SPY, it had 55 million moves, on average 85.4. This was a light day on average, right? QQQ volume was 38.7, average 56.7, light day for QQQ. And this is Tuesday, excuse me. So Tuesdays are really not that volatile, not that much is going on. It's depending on the underlying market and what's scheduled for the week, right? So Dow, 6 million on average is 6.3. So again, another light day. So price moves plus heavy volume equals a strong signal. We have a strong conviction, and that's a big body candle, which I like to call, right? Because this lets us know that there's a lot of conviction, there's a lot of movement in the room. Everybody wants a little bit of that action. Maybe there's FOMO going on. Maybe there's a little bit of panic. If you're looking at a red candle, that lets me know that there's a strong move based on whatever signal that you're looking at. So price moves plus light volume equals you have to be cautious. You have to make sure you're using different indicators in order to make sure that you're double confirming that move. Yes, it could be a signal, but if it's light volume, there's not that much participation. If there's not that much participation, why even go into the move? So another thing we're going to go over is the bid-ask spread. This is going to be the cost of trading. So I like to think of it like this, right? Whenever you want to get into the market, and it may sound crazy, but hey, this is how I learned. Whenever you want to get into the market, right? Or let's back up. when you want to go to somebody's house, some people don't do it. Some people just like to show up, right? But normal, whenever you want to go to somebody's house, right, what do? Don't you ask to go to somebody's house, right? So think about it this way. Whenever you want to get into the market, you have to ask to get into the market. So we're going to be paying the ask price, right? So this is the price we're going to be paying when we get into the market. When we get out of the market, we want to set up a bid, right? And want to be able to get the highest price possible. So we want to get out of the market. We're going to be getting the bid price, right? So getting into the market, you're paying the ask. So you're asking to get into the market. And when you want to get out of the market, you're putting up a bid and trying to get the highest price possible. The difference between the ask and the bid is going to be your trading cost. Now, tight spreads is going to be super liquid, easy to trade. Now, QQQ, tight spreads, easy to trade. SPY, tight spreads, easy to trade. Wide spreads are going to be your Dow. These are going to be illiquid, right? Very hard to trade. And what does it mean to trade? To get in and out of the asset. So if you're buying a stock, right, and if you want to get out of the stock, if it's tight spreads, right, you're not going to be able to get out of it as fast as you want to, right? If it's a little bit, if it's illiquid, right? Where if it's easy to trade, right, you can be able to get in and out of it super quick. Now, SPY is going to be one of the most liquid ETFs out there, right? Because there's a lot of volume. A lot of people are trading SPY. You have QQQ, another example of a very liquid, tight spread ETF, right? So current spreads, and this is kind of going against the grain, but just current spreads right now, the bid of 695.59, the ask of 695.75, the spread of 16, the spread is wide. QQQ 632, 632.05, the spread is tight, right? So it's easy to get in and out, right? DIA normally is usually wide. SPY just had a bit of an off day, right? But it was bearish. So excuse me, it was bullish. So you can see how, yes, it could be bullish, but the spreads could be a bit wide, right? And DIA normally is wide. Bid, what you pay to get out. Ask, what you pay to get in. Spread is 25, right? And that is wide. Wide spreads eat away at your profit. Always check these spreads before trading, especially when it comes to options. Now, handles and ticks, right? So a handle is going to be the whole dollar amount. So when somebody says, excuse me, SPY is at the 500 handle, that's letting me know that SPY is trading around 500, right? When somebody says SPY broke the 505 handle, SPY just moved above 505, right? So handles are the psychological levels traders watch. The tick is the price, the minimum price movement. Stocks 0.01 equals 1 tick. Option 0.01 equals 1 tick. Some futures, different tick sizes. And again, I don't trade futures, so I'm not going to go down that route. That is a conversation for another day. But you can see here that stocks and options, what we normally trade, are 1 tick for 0.01, 0.01, 1 tick, right? This is the minimum price movement. Can't trade at 500, 0.05, only the 100th place, right? You can't go to the, excuse me, I keep doing that. This is the 10th. This is the 100th and 1000th. Yeah. You can't go to the 1000th place. It's only the 100th place that you can go to when it comes to the tick or being able to trade stocks and options, right? Futures a little bit different. So major handles are going to be 500, 510, 520, act as magnets. Price often bounces or breaks at these levels. All right, so here's a live look at the market. A little bit more to being able to put it all together, right? So looking at SPY, it's 695. The point today was about 147, or it moved $1.47. The bips were 0.21, or excuse me, the bips were 21 or 0.21%, and the volume today was 55.1. So what you hear somebody say, all right, SPY on average had a light day because the volume was a little bit below. The bips were about 21, but we're looking at 1.47 points. So On average, we're looking at SPY having a little bit of a bearish move, but traders to be cautious because of the volume light participation there. And then we have QQQ. QQQ closed at 632.05. So we have the points today moved to 3.14 or 50 bips, or 50 bips is going to be that 50%, 0.5%. The volume was 38.7, so a little bit light for QQQ. A DIA closed at 48.75. The points were negative 94 or negative 19 bips. That negative 19 bips translates to 0.19%. The volume was 6 million. So decoding the language, SPY was up 21 bips on light volume near the 695 handle. So up lets me know that, okay, this is a bullish move, right? The 21 bips, 0.21. So this is the up. The light volume lets me know that this is light conviction, so not that much participation there. The 695 handle lets me know that it's at the 695 level. So QQQ gained 3.14 points, up 0.5 in a tech rally. So gains lets us know that we're in a little bit of a bullish rally, a little bullish momentum. 3.14 is $3.14 move, and 0.5 is 0.50 return in that return. So now we can understand what's going on there. So this is what we broke down, being able to understand points versus dollars, basis points, percentages, being able to go over volume and liquidity, understanding bid and ask, handles and ticks, and we went over the live data. Now what we're going to do is go into our, we have one more that I want us to do real quick. This 102, and 102 is just going to solidify a little bit more things for us. All right, so I know you've been hearing it. Bears, bulls, right? Bulls, excuse me, bears, buyers, sellers. So bulls are going to be the buyers. These are going to be the individuals that are optimistic. So this is whenever you hear the battle between the bears and the bulls, right? So that's really what you're looking at. Each one of these candlesticks represents what I like to think about, right, is a battle between the bears and the bulls, right? So let's go back here. The battle that drives every price move. The bulls are going to be the buyers, the individuals that are optimistic. They believe that the price will go up. They want to buy cheap and they want to push the price higher. Those are the bulls. The bears are going to be the sellers. They're going to be a little bit more pessimistic. They believe the price will go down. They want to sell high and they want to push the price lower. So market types is going to be the bull market, as the price is raising or rising over time, trending upwards. A bear market is the price is falling over time, trending downwards. Each trade has a bull and a bear, buyers plus sellers. The side with more force wins and moves the price. So when we're looking at candlesticks, right? So let's jump back over here. The green candlesticks are going to be our bulls or the buyers, right? So their aim is to be able to do what? To push the price up. And then the red candlestick are going to be our bears or our sellers, and their aim is to be able to push the price down, right? All right, so let's go back. Pro tip, when you hear bulls are in control, it means that the bulls or buyers are winning and the price is going up. Reality check, market isn't always bullish or bearish, right? Sometimes it's choppy, meaning that the bulls and bears tied. They went into the fourth quarter and nobody won. That's crazy. All right, long versus short position. Two ways to make money in the market. So a long position, meaning that we own the asset. We buy first and then we sell later. We profit when the price goes up. This is the most common thing beginners will do, right? So SPY's at $6.95. We sell at $7.10. We made a $15 profit. That $15 profit is what happens when we're in that long position. The short position is when we borrow and when we sell the asset. So we sell first, we borrow shares, and then we buy it later. We profit when the price goes down. This is a little bit more of an advanced strategy, a lot more risky. An example would be short SPY at $6.95, and then we buy it back at $6.80 with a $15 profit. So a long position is going to be bullish. We're betting that the market is going to go up. A short position is going to be bearish. We're betting that the market is going to go down. Pro tip, with options, you can go long or short easily. Buying calls is going to be long. Buying puts is going to be short. We'll cover this in a bit. All right, market cap is going to be how big is the company. Market cap equals the stock price times the outstanding total shares. It's the total value of the entire company. So the market size categories. The mega cap is going to be companies that are over 200 billion. These are going to be Apple, Microsoft, Nvidia. Large cap are going to be companies between 10 billion and 20 billion. This is going to be Tesla, Netflix, Uber. Mid cap are going to be companies between 2 billion and 10 billion. This is going to be growing companies. Small cap are going to be companies between 300 million and 2 billion. This are going to be smaller, riskier companies. And then micro cap are going to be companies under 300 million, right? So there's going to be very risky, volatile companies, right? So an example, mega cap is going to be Apple, Nvidia. Large cap is going to be Tesla. Then we have Square, which is the payment processing company, is going to be mid cap. And then we have Plug, which is the EV company, is going to be small cap with 2 billion. That's crazy, right? 2 billion small cap. That's crazy. Pro tip, large cap companies are less volatile, more stable. Small cap companies are more volatile, so you have a higher risk reward. Reality check, small cap companies can go 10x or go to 0 in a matter of seconds. So you have to match your position sizing based on your risk tolerance. Now it's going to be the order type, right? How do you actually enter and exit your trade? The market order, you're going to be buying right now. So for a market order, you're going to be sometimes overpaying, right? Overpaying or underselling when it comes to market orders. Let's go into that. So buying and selling right now at the current price. So you execute instantly, guaranteed to fill, but you pay the ask buy and you get the bid selling. You can get stuck at bad prices in volatile markets. This is used when you want to either get out of a trade and speed matters more than price, right? Now, limit orders, what I normally tend to use is you're going to be buying and selling at your price or better. So we control the price. We save money on the spread. We might not fill if the price doesn't reach your limit, right? And you can miss the move while we're waiting. So when to use, when you want a specific entry and exit. So an example would be SPY's trading at the bid is 695.67. The ask is 695.71. The market, in order to buy right now, in order to get in, you pay 695.71, which is going to be the ask, and you fill instantly. And then the limit buy is you're waiting for the price to drop, but it might not fill. So pro tip, for liquid assets like SPY, Apple, we use market orders. For options with wide spreads, always use limit orders. Reality check is that market orders are illiquid and options tend to rip, meaning that sometimes you get a terrible fill. All right, so now we're going to jump into our trading hours and being able to understand what are gaps and when can we actually trade in the US stock market. So the US stock market is open on EST, or the Eastern Time Zone. And for pre-market, that's going to be between 4 a.m. and 9:30 a.m. That's when we're going to see low volume from 9:30 a.m. to about 4 p.m. Excuse me, I don't want to cough in your ear. That's where it's going to be regular hours. This is when we're going to see most volume. And from 4 p.m. till 8 p.m., this is going to be after hours. We're going to be seeing low volume. Now, what is a gap? A gap up is when the price opens higher than it closed yesterday. And then a gap down is when the price opens lower than it closed yesterday. Now, what precipitates a gap, right? What makes a gap happen? There could be several things. It can be a news released after the market closed. That can be earnings or an event. It can be global market moves overnight because Europe and Asia trades on different hours, or it could be pre-market creating different price levels. All right, so now we're going to jump into the support and resistance levels. This is going to be the price floor and the ceiling that matters. So the resistance is going to be the price level where the selling pressure stops and the upward moves, right? This is the price ceiling. So the sellers are pushing back here. So resistance is at 700. The price is bouncing back down. And then the support level is going to be where the lowest low that the price is at. So I like to use a different example. Let's go here. So this is going to be our underlying price, right? Our support level is when the price is making a lower low, and our resistance level is when the price is making a higher high, right? So whenever you hear that an asset or the price is crashing through the support level, that means that it's making lower lows, and that's normally when we buy, right? And then when we hear that it's crashing through the resistance levels, it means that it's making higher highs, and that's normally when we sell. All right, good deal. So now let's go ahead and jump into our candlestick information so we can really understand what's going on now that we get the market terminology. So we're going to be going over the candlesticks and understanding how it works. So what is a candlestick? A candlestick shows 4 price in one period. The upper wick is going to be the high. The open is going to be the body of the green. The close is going to be the top of a green candle, and the lower wick is going to be the low. So the 4 parts of a candlestick is called the open, high, low, close, and you can also throw in V for volume too. So the 4 parts of a candlestick, right? Open, high, low, close, and volume. The body is the distance between the open and the closed, and the wick is how far the price went beyond the open close. So time frames, day trading are going to be normally using, I like to drop down to 1 minute, not really 5 minutes, because I use 1 minute candlesticks. So between 1 minute and 15-minute candlesticks, these are for quick moves. For swing trading, this is going to be 1 hour to 4 hour. These are going to hold for days or weeks. And then for investing, dailies or weeklies, these are for long-term trades. So a green candle is going to be a bullish candle. This is when the price went up. So the close is going to be at the top of the candle. The open is going to be at the bottom of the candle, right? So let's go look at the actual candlestick, right? So looking at this candlestick here, the open is going to be here, and then the close is going to be up here for a green candlestick. So you have to remember that for a green candlestick, whenever you're looking at the open, all right, bet the open was at 631.45 for this particular candlestick, and then it closed at 631.68, right? And that's for a green candlestick. Now green candlestick lets us know that we are bullish on the market, so we think the market is going to go up. Now for a red candlestick is going to be the inverse. The open is going to be at the top, and then the close is going to be at the bottom, right? So let's go look at the red candlestick. Red candlestick, the open is up here. So it opened at 631.65, and then it closed at 631.34. So for a red candlestick, we are bearish on the market. We think that the market is going to go down. And then for a green candlestick, we are bullish on the market. We think the market is going to go up. So just to be able to really drive this point in, when we're looking at a green candlestick, the open is at the bottom. So green, open low, right? So just to be able to open low, close high. right? Green, open low, close high, right? Close at the top. And then red, open high, close low, right? So we can understand that. All right, bet. So let's go back to our session. So a green candlestick is that the close was a greater than the open, the buyers won or the bulls won. And then a red candlestick is that the close was less than the open, the sellers or the bears won. So what is a doji? A doji lets us know that nobody won, right? So a candlestick, right? Whenever we're looking at candlesticks, right, it lets us know what happened. So I'm looking at a candlestick for QQQ. This is the QQQ chart. Excuse me. I don't want to cough in your ear. So this is the QQQ chart, right? So this is the chart, meaning that each one of these candlesticks represents 1 minute of action between the buyers and the sellers, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9. Let's bring, hold on, 10. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right, bet. So what I'm looking at is 10 minutes of action between the buyers and the sellers, right? Because each one of these candlesticks represents 1 minute of action. So when we see a big candle here, let me use this one because this is the biggest green candle. When we see a big candle here, that lets me know that, all right, there's a lot of momentum, there's a lot of conviction with the bulls or the buyers, and they're trying to push the price higher to resistance levels, right? But there was a bit of rejection. How do we know that there's rejection? Because these wicks that are popping out, can you see? Yeah, these wicks that are popping out. Because we have these wicks that are popping out, that's letting us know that there's rejection at the resistance levels, right? Now, remember, we talked about resistance. When we have rejection at the resistance levels, that lets us know that the bulls were trying to push the price up. Now, once they hit that peak is now rejected. That becomes the highest high for this particular candle, right? Now, if that's the highest high for this particular candle, what's going to happen is that normally, now there's sometimes that momentum keeps going and things could skyrocket, right? But normally what happens is that the bears will step in and try to push that price down to support levels, right? So here we're having 4 straight candles, right? So 4 straight candles of a bullish momentum. And then now we have dojis here. These dojis are indecision. So nobody really won. So even though it turned out being a green candle, so quote unquote, the bulls won, but there's what lets me know that there wasn't that much conviction in the move, right? Let's go back to our code. So the tug of war means that there's nobody won. The open is kind of equal to the close, right? Tiny or really nobody. What this means is that the buyers or seller are equally matched. Indecision in the market often appears before a trend reversal, right? So algo tip, easy to trade, is that we're going to check if the open is less than the close, minus the close, excuse me, less than the threshold. Reality check, it works 60% of the time, confirmed by the next candle, right? Always use a stop loss below or above the doji range. So the next thing we're going to look at is the engulfing candle. An engulfing bearish candle is when we have a big candle with not that much of a wick, right? So let's go look back at our candle. So right here is going to be engulfing bearish candle when we have a bearish candle that is a big body candle, right? A candle that has a lot of conviction, a lot of volume, a lot of signal letting us know that, okay, the buyers are really stepping up to the plate. Then we have the engulfing bullish candle right here. Same thing, but just for the bulls, right? So let's go back to our code. So the bearish one means that the sellers took control and the price may drop if we're looking at a bearish engulfing. And then a bullish engulfing is letting us know that the buyers took control and the price may go up. So strong reversal signals whenever we see engulfing candles, right? Algo tip is that the current body is greater than the previous body and the opposite direction. This is how the code will look if you wanted to be able to code it out for you. Now we're going to go to hammers. Hammers are going to be the bounce off the floor. So the sellers tried and then the buyers fight back. So we have a hammer when the small body and a long wick, right? So the small body on top and then the long wick. Let's go look at our code to see if we could go find a hammer real quick, or a hammer right here. Hold on. I want to find you a hammer. Oh, right here. There we go. We have a hammer. Small body, long wick, right? So they tried to push the price up, but then they failed because we see this wick here, and this wick is letting us know that there's rejection, right? And then we have the inverted hammer. Inverted hammer is right here, right? And is that the sellers tried to be able to push the price down, but it was rejected, and we see that wick populating here. So what this means is that the long wick equals the price was rejected at that level. The hammer at the bottom equals a potential bullish reversal. A lower wick, excuse me, should be 2 to 3 times the body size. So algo tip is that the lower wick is 2 times the body size and the upper wick is less than the body size. Only reliable at support and resistance levels. Random hammer mid-trend means nothing. So this is where we're going to pause, right? Because I don't want to make this video too long, so we can actually grasp the concept. So I want to drop a part 2 of this video so we can go into a little bit more of the advanced tricks for being able to read candlesticks. Now, it is your boy Kreative. If you haven't already, I need you to go ahead and like and subscribe, and we'll be dropping part 2 candlesticks in order to really get into our work here. But it's your boy Kreative. I'll be back at it again with another episode.